Imagine this. You walk into one of the most secure vaults in the Western world, a vault operated by the COMEX, the exchange that has settled trillions in precious metals contracts over the last half-century. You walk past the steel doors, past the armed guards, past the cameras, and what you find inside is a room that is emptying, faster than it ever has, faster than anyone predicted. 75% of the silver that sat in these vaults just 4 years ago is gone. Exposed concrete where 1,000-ounce bars once stood in towering stacks. 15 consecutive months of record withdrawals, and the metal is not coming back. Now imagine this. While those vaults drain, J.P. Morgan, the most powerful bank on earth, the institution that has dominated the silver market for decades, quietly publishes a forecast. They predict silver will average $81 an ounce in 2026, not as a ceiling, as an average. And they are not even the most bullish voice in the room. Bank of America says silver could hit $309. Deutsche Bank targets 100. UBS says 85. And Robert Kiyosaki, the man who has been telling you to buy silver for 20 years, says $200 is next. This is not a fringe story. This is not Reddit. This is not a conspiracy theory. This is the world's largest financial institutions staring at the same set of facts and arriving at the same conclusion. Silver, the most overlooked, most misunderstood, most undervalued asset on the planet, is entering a crisis that has no modern precedent. My name is Marcus Hale, and today I am going to show you what is really happening to the silver market, what the banks know, what the vaults reveal, and why, by the time most people understand what is unfolding, it will already be too late. Let me start with the thing nobody is talking about on cable news. The physical silver supply in the COMEX warehouse system, the backbone of the global silver futures market, is collapsing. At its peak in 2020, the COMEX warehouses held approximately 346 million ounces of silver. That was the high water mark, the moment of maximum comfort. Every futures contract, every paper claim, every leveraged bet on silver's price had a cushion of real, tangible metal backing it up. That was 4 years ago. Today, registered silver, the metal actually designated and available for delivery against futures contracts, sits at roughly 76 million ounces. That is a decline of more than 75%. 3/4 of the deliverable silver is gone, and the pace is accelerating. To understand why this matters, you need to understand a distinction that most investors never learn. Inside a COMEX vault, silver exists in two categories: registered silver and eligible silver. Registered means the metal has a warrant attached to it. It is available right now, today, to be delivered to anyone who stands for physical delivery on a futures contract. This is the exchange's actual ammunition. Eligible silver is metal that meets COMEX specifications, the right purity, the right bar weight, but belongs to private owners who have not made it available for delivery. Banks hold it, ETFs store it, private investors park it there for safekeeping, but it cannot be used to settle a contract unless the owner voluntarily converts it. This distinction is everything, because when analysts talk about COMEX running out of silver, they are not talking about eligible, they are talking about registered. The pile that the exchange can actually draw from, and that pile is shrinking at a rate that should alarm anyone paying attention. For 15 consecutive months through early 2026, physical silver has been leaving COMEX warehouses at volumes the exchange has never processed, not in its entire history. Every single month during this stretch set a new record for that particular month. The pattern is not cyclical, it is directional. Metal is leaving, and it is not being replaced. The numbers tell the story with brutal clarity. In all of 2024, COMEX delivered 203 million ounces of physical silver. That was already elevated. In 2025, that number more than doubled. 474 million ounces left the system. Every single month of 2025 saw higher deliveries than the corresponding month in 2024. Not most months, every month. Then December 2025 arrived and shattered everything. In that single month, COMEX processed nearly 65 million ounces in physical deliveries, 12,946 contracts, the largest single-month delivery figure in the history of the exchange. Over 47 million ounces were claimed in just the first 4 trading days. The exchange was overwhelmed. Reports emerged that 95% of delivery requests were settled in cash because the physical metal simply was not there in sufficient quantities. January 2026 followed with another 49.4 million ounces. To put that in perspective, January is not even a primary delivery month on COMEX. It is supposed to be quiet. The typical January in recent years moved between 1 and 2 million ounces. January 2024 delivered approximately 6.8 million ounces. January 2026 delivered 7.27 times that amount, in a month that is not supposed to matter. Here is where it gets interesting. The people draining these vaults are not who you might expect. When silver leaves a COMEX warehouse, the natural assumption is that it is going to a factory, a solar panel manufacturer, an electronics company, someone who needs the metal to make something. But that is not what the data shows. Industrial users do not typically source silver through COMEX. They have offtake agreements with mines. They buy refined silver directly from smelters. A photovoltaic manufacturer in China does not send someone to a New York vault to retrieve 1,000-ounce bars. The entities standing for delivery at COMEX are, by every indication, institutional investors, hedge funds, sovereign-adjacent capital, investment trusts. They are not buying silver to make solar panels. They are buying silver because they believe the metal itself is worth more than the paper price suggests, and they want to hold the physical asset, not a contract that promises future delivery. Consider what happened on January 7, 2026. On that single day, 1,624 January silver contracts were delivered, representing 8.12 million ounces. J.P. Morgan, acting as the issuer, was responsible for 99% of those deliveries. But here's the detail that should stop you cold. Despite those massive deliveries clearing through the system, open interest in the January contract actually increased by 1,431 contracts that same day. New buyers were arriving faster than metal was being delivered. Analysts described it as using the COMEX futures market not for hedging, its intended purpose, but as a physical delivery mechanism for immediate acquisition of metal. The Sprott Physical Silver Trust made this dynamic explicit. In December 2025, Sprott announced a $1 billion at-the-market equity program to purchase physical silver. 5 weeks later, on January 20th, 2026, they doubled it to $2 billion. At the prevailing price of roughly $110 per ounce, that $2 billion could acquire approximately 18 million ounces, equivalent to roughly 16% of all remaining COMEX registered inventory. One fund, one capital raise, 16% of the vault. And the math only gets worse from here. As of early 2026, the paper-to-physical ratio on COMEX stood at approximately 7.1 to 1. That means for every single ounce of registered, deliverable silver in the vaults, there were 7.1 paper claims outstanding against it. The coverage ratio had fallen to just 14%. Some analysts calculated that at the prevailing rate of withdrawals, roughly 785,000 ounces per day, the registered inventory would be fully exhausted in approximately 131 trading days. 131 trading days. That is not a generation. That is not a decade. That is roughly 6 months. Section 3. The banks have seen the numbers. Now let me connect this to the second part of this story, because while the vaults are emptying, the banks are not sitting quietly. They are publishing forecasts that would have seemed insane 2 years ago. On February 10, 2026, J.P. Morgan Global Research released an updated silver outlook, authored by Gregory Shearer, the bank's head of base and precious metals strategy. The headline number was $81 as the projected average silver price for 2026. Not the peak, the average. Their quarterly breakdown projected $84 in the first quarter, $75 in the second, $80 in the third, and $85 in the fourth. Their 2027 outlook was $85.50. What makes this forecast remarkable is not just the number, it is the revision. In November 2025, J.P. Morgan had silver at $56.30 for 2026. 3 months later, they raised it 44% to $81, the largest single upward revision in their silver coverage in recent memory. Something changed their thinking dramatically between November and February. That something was the physical market. Shearer explained the thesis in a recorded podcast. Silver and gold are sister metals, he said, trading in sharp correlation. Gold's push toward $5,000 per ounce, driven by central bank accumulation and ETF inflows, provided the foundation. But silver's move was amplified by a tariff-driven physical squeeze that dislocated the entire global market. Here is what happened. In early 2025, when the Trump administration began signaling Section 232 investigations into critical minerals, traders feared that silver imports could be hit with tariffs. The rational response was to move physical metal from London, the world's primary physical hub, to New York before any tariff took effect. And they did. Thousands of tons of silver flowed across the Atlantic into COMEX warehouses. London's physical market became extraordinarily tight. Lease rates spiked. Spot prices in London commanded premiums of up to $3 per ounce over New York during peak stress. Then, when the tariff threat eased in January 2026, the dynamic reversed. Metal began flowing back. But the disruption had exposed something critical. The global silver market did not have enough physical metal to handle a logistical shock. The buffers were thinner than anyone realized. J.P. Morgan was not alone in recognizing this. Bank of America, through analyst Michael Widmer, published a range of $135 to $309 per ounce by the end of 2026. Their base case assumed the gold-silver ratio compresses to 2011 levels, roughly 32 to 1, which with gold near $5,000 would put silver at 156. Their bull case used the 1980 Hunt Brothers ratio of 14 to 1, implying silver above 350. Deutsche Bank revised their target to approximately $100. UBS projected a peak near $100 around mid-2026, settling to 85 by year-end. A Reuters poll of institutional analysts returned a median forecast of $79.50, up from $50 just 4 months earlier. And then there was Robert Kiyosaki. On December 29, 2025, with silver crossing $80, the author of Rich Dad, Poor Dad posted his prediction, $200. His reasoning was blunt. Silver is the structural metal of the modern economy. Unlike gold, which sits in vaults, silver gets consumed. It goes into solar panels and circuit boards and medical devices and military systems. It does not come back. He called it the best investment opportunity of all time. The $100 moment and what followed. To understand where silver is going, you have to understand what happened in January 2026. Because what happened in January was both a validation and a warning. Silver entered 2026 at approximately $71.59 per ounce. It had already risen roughly 147% during 2025, the strongest annual performance since 1979, breaking through the old Hunt Brothers nominal high of $49.45 in October. December closed with silver near $72, riding the momentum of record COMEX deliveries and surging demand from China and India. Then January accelerated. Chinese retail investors piled in. Indian demand surged. The Section 232 investigation remained unresolved. China's new export controls on silver had taken effect on January 1st, tightening the available global supply. The Shanghai premium, the difference between Chinese silver prices and Western prices, widened to more than 12%, roughly $9 per ounce above London and New York. Silver was in backwardation in China, meaning the spot price exceeded futures prices, a classic signal of acute physical demand stress. Silver crossed $100 around January 26th. It was the first time in history the metal had traded in triple digits. The psychological significance was enormous. For 45 years, $50 had been the ceiling, the Hunt Brothers' peak, the level that seemed to carry a curse. Silver broke through 50 in October 2025 and doubled it in less than 4 months. By January 29th, silver hit $121.62, the all-time high, a gain of approximately 56% in just 27 days from the start of the year. The speed was breathtaking. It felt unstoppable. It was not. On January 30th, President Trump nominated Kevin Warsh as the next chairman of the Federal Reserve. Warsh, a former Fed governor known for dissenting against quantitative easing in 2010, was viewed by markets as an inflation hawk. His appointment signaled tighter monetary policy, a stronger dollar, and less accommodation for precious metals. Silver crashed 39% intraday, from $121 to as low as $85, before rebounding slightly to close near $88. It was the worst single day for silver since March 1980, since Silver Thursday itself. Gold fell 9 to 16% the same afternoon. By February 6th, silver had retreated to $63.90, a total correction of 47.5% from the all-time high. The crash was violent, but it did not change the fundamentals. The vaults did not refill. The supply deficits did not close. The industrial demand did not evaporate. And the banks did not withdraw their forecasts. J.P. Morgan published their $81 average on February 10th, 11 days after the crash. They had seen the sell-off and still raised their target. Let me tell you why the banks are not backing down. Because underneath the price volatility, underneath the headlines, there is a structural reality that no amount of selling can change. The world is consuming more silver than it produces, and it has been doing so for 6 consecutive years. The Silver Institute, which publishes the definitive annual World Silver Survey, confirmed that the silver market recorded a supply deficit of 148.9 million ounces in 2024. That followed a deficit of 200.6 million ounces in 2023 and a record deficit of 237.7 million ounces in 2022. The deficit began in 2021. Over the 4 years from 2021 through 2024, the cumulative shortfall reached 678 million ounces, equivalent to 10 months of total global mine production. By the end of 2025, the cumulative deficit exceeded 800 million ounces. 2026 is forecast to be the 6th consecutive deficit year. The deficits persist because of a structural asymmetry that most people do not understand. Silver is not primarily mined as silver. Approximately 70 to 80% of all silver production is a byproduct of mining other metals: copper, zinc, lead, gold. Only 20 to 30% comes from primary silver mines. This means that when silver prices rise, mining companies cannot simply ramp up production the way oil producers can drill more wells. Silver output is a function of copper economics, zinc economics, lead economics. The metal does not respond to its own price signal. Global silver mine production peaked in 2016 at 900.1 million ounces. It has declined by an average of 1.4% per year since then. Ore grades have dropped 20%. The top 5 producing countries, Mexico, China, Peru, Bolivia, and Chile, account for 62% of supply, and several face declining output in the years ahead. New mine development takes 5 to 10 years from discovery to production. There is no cavalry coming. Meanwhile, the demand side is undergoing a historic transformation. Industrial fabrication consumed a record 680.5 million ounces in 2024, nearly 60% of total demand. That share was approximately 50% a decade ago, and it is still climbing. The single largest driver is solar energy. Photovoltaic manufacturing consumed nearly 200 million ounces of silver in 2024, representing 29% of all industrial demand, up from just 11% in 2014. Every solar panel requires silver paste for its electrical contacts. Global solar capacity additions hit records in 2025, with China alone increasing its installed base by 45%. The energy transition is not a projection. It is happening, and it consumes silver at a rate that dwarfs historical patterns. Electric vehicles add another layer. Each EV requires 25 to 50 grams of silver, 67 to 79% more than a conventional internal combustion vehicle. The Silver Institute projects automotive silver demand growing at 3.4% annually through 2031, with EVs overtaking traditional vehicles as the primary source of automotive silver consumption by 2027. Then there is the artificial intelligence build-out. Global data center power capacity has increased 53-fold since the year 2000, from under 1 gigawatt to approximately 50 gigawatts. Every server rack, every high-performance computing cluster, every power delivery system uses silver-plated connectors and contacts. Silver is the most electrically conductive element on the periodic table. There is no substitute that matches its performance in high-frequency, high-reliability applications. Add 5G infrastructure, where each device contains roughly 40% more silver than its 4G predecessor. Add nuclear power, where silver, indium, cadmium alloy control rods are essential to reactor operation. Add the 60-plus new nuclear reactors projected worldwide by 2030, many driven by the power demands of the very AI data centers that are already consuming silver. Every major technological trend of the next decade converges on the same metal, and that metal is running a 6-year supply deficit with no structural resolution in sight. Section 6. China changes the game. On January 1, 2026, China implemented a new export licensing regime for silver. Under the new rules, which cover a 2-year period through 2027, all silver exports must be conducted by state-approved trading enterprises holding individual export licenses. Firms must demonstrate consistent annual exports from 2022 through 2024 to qualify. New applicants must prove annual production exceeding 80 tons. The number of authorized exporters has been reduced to a bounded list. Reports indicate that export volumes have dropped by as much as 40% compared to the prior year. This matters enormously because China controls approximately 60 to 70% of global silver refining capacity. When China restricts silver exports, it is not a marginal adjustment. It is a restructuring of the entire global supply chain. The move mirrors China's rare earth export playbook, using licensing controls to prioritize domestic industrial consumers while constraining international availability. The effect was immediate. The Shanghai silver premium widened to more than 12% above Western spot prices. Silver in China traded at roughly $85 to $86 per ounce, while Western markets quoted $76. The Shanghai market went into backwardation. Metal that once flowed freely from Chinese refiners to global markets was being held back, consumed domestically by the world's largest solar panel manufacturing base, the world's largest EV production complex, and the world's most aggressive electronics sector. JP Morgan flagged this as a potential upside surprise for 2026. If tariff threats on critical minerals revive, their analysis noted, the physical squeeze that roiled markets in 2025 would return. Metal would once again rush from London to New York, recreating the illiquidity that helped drive prices to record levels. With China now restricting outflows on one end and tariff fears potentially restricting imports on the other, the physical silver market is being squeezed from both directions simultaneously. This is not 1980. Every time silver rallies, someone mentions the Hunt brothers. It is the ghost that haunts every precious metals bull market. Two Texas oil billionaires who tried to corner the silver market in 1979, driving prices from $6 to nearly $50 in 12 months before regulators changed the rules, triggered margin calls, and collapsed the entire position on Silver Thursday, March 27, 1980. The Hunts lost over $1.7 billion. Silver did not recover to its 1980 high for 45 years. The comparison is understandable. It is also wrong. The Hunt brothers were two men with borrowed money attempting to manipulate a market by hoarding physical supply. They controlled roughly 1/3 of the world's deliverable silver. When exchanges restricted their ability to buy, the entire thesis collapsed because it was built on one concentrated, leveraged bet. What is happening in 2026 is the opposite in almost every structural dimension. The demand is not concentrated in two speculators. It is distributed across hundreds of institutional investors, ETF programs, sovereign-adjacent funds, and millions of retail participants across multiple continents. Goldman Sachs described it as a diffuse army of investors, ETFs, and algorithmic funds. When demand is this broad, no single rule change can break it. In 1980, silver's industrial demand was modest, primarily photography and basic electronics. Investment and monetary demand dominated. There was no solar industry consuming 200 million ounces a year. There were no electric vehicles. There were no AI data centers. The industrial demand floor that exists today simply did not exist then. The Hunt brothers created artificial scarcity by hoarding. Today's scarcity is structural. 6 consecutive years of supply deficits, declining ore grades, byproduct dependency, Chinese export controls. These are not features of a speculative bubble. They are features of a market where consumption systematically exceeds production and has for half a decade. And perhaps most critically, in 1980, silver's rise was purely a monetary phenomenon, driven by inflation fears and speculative mania. In 2026, the monetary argument and the industrial argument are reinforcing each other simultaneously. The green energy transition needs silver. The AI revolution needs silver. The monetary system's instability makes silver attractive as a store of value. Each driver amplifies the others. Remove one, and the case still holds. That does not mean silver cannot fall. It already did, 47% from its January peak. Volatility is the price of admission in a market this small. J.P. Morgan's analyst explained it plainly. Silver's physical market is about 1/10 the size of gold's. Even in futures, silver is 1/5 the size. A 1 or 2% down day in gold can translate to 10 or 15% in silver. And unlike gold, silver has no central bank buyer of last resort, no structural floor from sovereign reserves accumulation. When momentum reverses, silver falls faster and harder than almost any major asset. But the vaults are still draining. The deficits are still running. The factories still need the metal. And the banks, the very institutions that understand this market better than anyone, are not forecasting a return to $30. They are forecasting 81 and 85 and 100 and higher. Section 8. The gold-silver ratio tells you everything. There is one more piece of this puzzle that ties it all together, and it is the single most powerful argument for silver's continued revaluation. The gold-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. The long-term 20th century average is roughly 47 to 1. The 21st century average is approximately 65 to 1. In April 2025, during the tariff shock that briefly hammered silver while gold surged, the ratio spiked above 100 to 1, 100 ounces of silver for a single ounce of gold. That was more than 2 standard deviations above the long-term mean, a level that has historically proven unsustainable every single time it has occurred. By January 2026, as silver rallied to its all-time high, while gold traded near $5,500, the ratio compressed to below 50 to 1. J.P. Morgan Asset Management published an analysis noting that using the gold-silver ratio as a historical proxy, the fair value for silver was closer to $75, with a 1 to 2 standard deviation momentum premium, implying 90 to 110. This is how Bank of America arrived at their extraordinary targets. At a ratio of 32 to 1, which prevailed in 2011, with gold at 5,000, silver reaches 156. At the 1980 Hunt Brothers ratio of 14 to 1, silver reaches 357. These are not fantasy numbers. They are mathematical calculations based on ratio levels that have actually occurred in living memory. The ratio is still elevated relative to history, and as long as gold continues its structural bull market, driven by central bank de-dollarization, geopolitical instability, and fiscal profligacy, silver has a mathematical tailwind that compounds on top of its own supply-demand fundamentals. So let me bring this together, because both of these stories, the vaults emptying and the banks revising their targets, are the same story. Silver is a market where physical supply is declining at record pace, where 6 consecutive years of deficits have consumed over 800 million ounces of above-ground inventory, where the exchange responsible for global price discovery has seen its registered stock fall 75% from peak, with 7 paper claims still outstanding for every physical ounce remaining, where the world's largest refining nation has restricted exports, where the fastest-growing industries of the 21st century, solar, electric vehicles, artificial intelligence, 5G, nuclear, all converge on a single irreplaceable metal, where a single investment trust can raise $2 billion and absorb 16% of remaining deliverable supply with one capital raise. And into this environment, J.P. Morgan, the bank that has dominated silver trading for decades, that delivered 99% of 8.1 million ounces in a single day's notices, tells you the average price will be $81. Not the peak, the average. And the other banks say even that is conservative. The question is not whether silver is going up. The question is what happens when the vaults reach 0, when the last registered ounce is spoken for, when the paper claims of 7 to 1 become 10 to 1, or 20 to 1, or the 28 to 1 levels already recorded at lowest inventory points, when China consumes every ounce it refines and exports nothing, when the solar industry alone needs more silver than the world's primary silver mines produce, That moment is not hypothetical. At current rates, it is roughly 131 trading days away. J.P. Morgan knows this. Bank of America knows this. Deutsche Bank and UBS and the analysts surveyed by Reuters know this. They have run the numbers. They have seen the vault reports. They have tracked the delivery data. And they are publishing forecasts that would have been considered delusional 24 months ago. Silver has always been gold's overlooked sibling. The metal people dismiss because it tarnishes, because it is used in industry, because it crashed in 1980 and people remember the story of two Texas billionaires more than they remember the fundamentals. But 2026 is not 1980. The demand is not artificial. The scarcity is not manufactured. And the institutions draining those vaults are not two brothers with margin accounts. They are the biggest money in the world, and they are taking the metal home. The silver market is small. The story is enormous. And by the time the mainstream catches on, the vault doors may already be closed.